The global economy is currently navigating a period of entrenched stagnation. Yet, against that backdrop, India's real GDP is expanding at an estimated 7.6%. That broader global slowdown is tied to hard constraints. Escalating tariff uncertainties and the ongoing conflict in West Asia are capping international trade velocity and overall global growth. India's decoupling from these global headwinds relies on deep internal demand buffers to offset the drag from net exports. This domestic buffer is supported by two specific macroeconomic pillars operating in tandem. Analyzing this growth requires shifting the analytical focus from external trade dependencies to these domestic structural pillars. The first engine driving this localized growth is private final consumption expenditure, or PFCE. PFCE is expanding steadily, following recent GST rate rationalizations and a measurable recovery in both rural and urban demand. The second structural pillar is gross fixed capital formation, representing aggregate investment activity. The scale of this capital formation is anchored by direct government policy, including the central government's allocation of 2 lakh crore rupees specifically for capital investment assistance to the states. This sustained public spending serves a specific macroeconomic function. It clears bottlenecks and creates the physical infrastructure necessary to crowd in private sector capital. This chart breaks down the 7.6% growth baseline, isolating the exact percentage contributions from private consumption and capital formation. Together, these twin engines establish a structural floor for long-term national expansion, providing a buffer against global trade fragmentation. That internal growth momentum faces one primary systemic friction: a bifurcated inflation topography. The data shows an anomaly. Core inflation remains firmly contained, while headline consumer price inflation exhibits sharp, intermittent volatility. The first force driving this headline volatility is domestic: cyclical disruptions in the agricultural supply chain. Current fluctuations in the headline rate are dictated by waning statistical base effects and acute supply shocks in perishable goods, specifically vegetables. The second force threatening price stability is exogenous: imported energy costs. As the conflict in West Asia intensifies, it strains the supply of critical downstream inputs and spikes global crude oil prices, importing inflationary pressure directly into the domestic manufacturing base. Headline inflation is currently a systemic tug-of-war between domestic agricultural base effects and exogenous geopolitical energy shocks. Navigating this dynamic requires intervention from the central bank through the monetary easing cycle. In response to easing inflation forecasts earlier in the cycle, the RBI reduced the policy repo rate by 25 basis points in December, bringing it down to 5.25%. That specific cut is part of a broader easing cycle, where total policy rate reductions have accumulated to 125 basis points. The standard macroeconomic assumption is that consumer and corporate borrowing costs will mirror this 125 basis point drop. The data shows a gap in transmission. While the repo rate dropped 125 basis points, the weighted average lending rate, the actual cost of fresh rupee loans, only fell by 89. That leaves a 36 basis point discrepancy between the central bank's policy action and the relief felt in the real economy. Using index number theory, we can deconstruct that lending rate into two competing variables: pure pricing effects and composition effects. When we isolate the pure interest rate effect, we see that banks actually passed on a 92 basis point reduction to individual loan prices. Looking exclusively at the headline lending rate misrepresents the physical flow of credit pricing through the real economy. The variable offsetting that pure rate cut is the composition effect, or the weight effect. This composition effect pushed back against the interest rate reductions, dampening the observed transmission in the aggregate data by 3 basis points. This occurs because overall credit volume shifted towards sectors that carry higher interest rates, skewing the overall weighted average upward, even as individual loan prices dropped. The efficiency of rate transmission is also governed by bank liability structures. These pie charts show a structural difference in how loans are benchmarked. Note the high share of MCLR, the marginal cost of funds-based lending rate, in public sector banks, contrasted against the heavy reliance on external benchmark lending rates in private banks. A high concentration of MCLR-linked loans creates an inherent lag in policy transmission, while banks utilizing external benchmarks execute a faster, more direct pass-through of policy rate cuts. Commercial credit reallocation and internal banking benchmarks heavily manipulate the actual flow of monetary transmission, often overriding central bank policy. Policymakers must balance robust internal momentum against external, supply-side inflation shocks. The theoretical framework for mapping this balancing act is the Taylor rule for inflation-targeting economies. This equation visualizes the baseline expectations of the Taylor rule, an inflation response coefficient of 1.6 alongside an output gap coefficient of 0.6. However, data reveals a behavioral shift. The central bank's inflation sensitivity has fallen from the expected 1.6 to 1.2. This decrease means monetary authorities are exhibiting lower sensitivity to the traditional inflation output gap trade-off. Authorities are adopting a steady hand, avoiding reactive rate adjustments driven by transitory base effects in domestic food prices. This modified policy behavior provides a strategic buffer, preserving maneuvering room in the event of sudden, severe external energy shocks. India's macroeconomic position in this cycle relies on a specific set of mechanics. The volatility of a fragmented global trade environment is countered by the structural floor of internal consumption and aggressive state capital expenditure. In this era, resilience comes from the systemic calibration of domestic buffers to absorb exogenous shocks.